How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you what are the best annuities for retirement income and really go into a pro and con analysis on common mistakes that individuals make when looking to purchase an annuity contract and then how to really look for the best annuity for the individual situation. So, if you're 50 years old and you want to place your dollars into an annuity, what might be the best option for you, or how to really look at that 30,000 foot view and say, okay, these are the different offers. This is how I decipher what the best offer is so I don't fall victim to that, most common mistake. And you could compare that to an individual that's age 60 that's looking to trigger income in the next couple of years. Those are going to be two entirely separate avenues with the 50-year-old versus 60-year-old on what might be the best, possible route. So to kind of take a step back, what exactly are annuity contracts? How exactly can they be used most efficiently? And then how could you figure out the best ones for your individual situation? And the annuity contracts are the opposite of life insurance. So life insurance companies were created, or I guess an individual would purchase a life insurance plan because they wanted to make sure that to protect themselves and protect their families from dying too soon. So they would be paying these small premiums, either every month or every year into a plan. God forbid they were to pass away, you have a lump sum death benefit amount that gets paid out to the beneficiaries. Annuities are the complete opposite of that. What happens is an individual would place a lump sum to an insurance company, and then that insurance company is going to guarantee them a set stream of income payments, whether on a monthly basis or an annual basis, to protect them from living too long. So both of those concepts, whether you're utilizing a life insurance concept or an annuity concept, they're all using the law of large numbers. So, how are they able to guarantee on a life insurance side a lump sum payment? Is they're using your dollars along with millions of other premiums to therefore understand the actuarial data that says statistically we should be able to collect these much amount of premiums to therefore invest it on the back end so that we're profitable. Same concept with annuity contracts is if they have the statistics, if they have all this actuarial data that says if a 60-year-old is placing their dollars with us and we understand that this person's going to trigger income at age 65, what are the exact decimal point? What is his projected age, his or her projected age that they should be passing away? So they utilize that data in conjunction with the law of large numbers with all these premium amounts to make that company profitable. So the first type of annuity contracts that came out were immediate annuities. What happened was an individual would go and say, I have $100,000. I want to go to an insurance company and purchase an annuity contract. And let's say this person is 60 years old. They go to this insurance company. That insurance company has a law of large numbers, and they say, okay, Mr. and Mrs. Client, because you're giving us $100,000, based upon your mortality table, we project that you're going to live until age 80, let's just say. So what that would equate to, and this is really, easy hypothetical example, is going to say $5,000 per year. We will guarantee you to cover your entire life. So this is the form of annuitization. This is the form of immediate annuities when you're looking at like single life only options, different things like that. And what this insurance company is saying is, okay, this person's 60 years old. We project that they're going to live for 20 years. We're going to pay them $5,000 per year. Now, the problem with this is an individual would go set up this contract, live a couple of years. Let's say, God forbid, they passed away after only 5 years. They would have been paid out a total of $25,000, and then the insurance company was able to take their lump sum, reinvest that on the back end, and then on top of it, make a $75,000 profit because this was projected on this person's life only. So some individuals would be living past that 20-year mark, where therefore they're now getting into the insurance company's pocket, and that every year past that 20-year mark that it would have paid back their $100,000, they're now saying, okay, well, I'm having $5,000 extra dollars, $5,000 extra dollars, $5,000 extra dollars. So for the individual that lives to age 100, they received an additional $100,000, and that was a profitable move for them. Majority of the times, because the insurance companies are controlling the actuarial data, they would say, okay, well, one person might pass away too soon, the next person might pass away too soon. Even if that person lives past that certain break point, they've already been able to make interest off of those monies because they're receiving it in the form of a lump sum. So a lot of individuals didn't necessarily like that concept of annuitization. They didn't like that concept of the single life only income because they're saying, I'm getting paid $5,000 a year. I understand this is going to last me for the rest of my life, but God forbid if I pass away within that 20-year mark, now my family receives nothing. I saved up this $100,000. I wanted to make sure to leave it to my family members, and now they don't receive a single dollar. So that was the problem with single life only plans or annuitization type contracts. So after the early 2000s, you had these types of contracts that came out that are annuity contracts with something known as an income rider. So we understand annuitization is when the individual is surrendering full control of their monies, receiving a guaranteed lifetime payment. But if this person passes away too soon, now all those dollars that they thought were that they didn't use up, rather than have that go to the beneficiaries, it would go directly back into the insurance company. So it's just going to add to that insurance company profits. So insurance companies, what they try to do is push a lot of the annuitization. They try to push a lot of the immediate annuities because they understand that that's what's going to be most profitable for them. You had the other variation that came out, which was annuity contracts. You could have it on variable annuities and fixed index annuities. And they have this concept with an income rider that somebody could attach to it. And what this does is it gets rid of that problem off of saying, hey, if I'm receiving $5,000, I threw $100,000 in with an insurance company and they're guaranteeing me $5,000 for the rest of my life. And let's say this person passes away after 5 years. Well, they would have got paid, 5,000 times 20, that would be 25 grand. And 75,000 is going back to the insurance company, and the insurance company was able to make money off of their money because they were able to leverage that lump sum. When you utilize like a variable annuity or fixed index annuity with income rider, understand I hate variable annuities to begin with, but I do like the concept of an income rider. If someone's using a variable annuity with an income rider or a fixed index annuity, I think a fixed index annuity with an income rider works a lot better than a variable annuity because it gives you higher contractual guarantees than with a variable annuity. And variable annuities have a lot of hidden fees off of like a 300, 400 page prospectus. So there's a couple different features there. But if we're talking about the retirement income play, what this does is, let's say if you have $100,000 and you have it with an insurance company that you attach an income rider to it, what this does is it says, okay, you're going to have your physical money account, which is known as an account value. And depending upon how this is structured, if it's variable, it's going to be hit with fees. It could go up with the market, could go down with the market. If it's a fixed index annuity, they could get hit with an income rider fee. If the market goes down, you're going to gain 0%. If the market goes up, you're going to receive a credit into your account. So it gives you more safe consistency. So let's say if the market goes, hell in a handbasket, doesn't really gain anything, and this person attached an income rider to this, and that income rider is allowing them to receive $5,000 of lifetime income, well, that $5,000 is going to be deducted from that account value each and every year. Let's say if all things remain equal, same exact scenario, this person passes away after 5 years, they would have $75,000 that's sitting in their account value. They would have been able to receive that $5,000. God forbid they pass away. Well, now $75,000 gets left over to the beneficiaries. So it allows the individual to have more control. Let's say if they live past that 20-year mark and there's nothing left in this account value and they keep living and living and living, they live into their hundreds. Well, just like this annuitization phase where they're getting into the insurance company's pockets, that's when it's profitable. This contract with an income rider, once again, there's going to be a break-even point right when there's no more dollars left to leave as an inheritance. That means now you're taking from the insurance company. Now you're in the insurance company's pockets to receive that $5,000 of lifetime income. So each year that you're living, you're basically sticking it to the insurance company that much further and further and further. So the income riders can be a very good way on how you're trying to decipher what are the best annuities for retirement income. The problem with the income riders is you have so many different, what I like to call smoke and mirrors, so many nice shiny objects out there that is more of a distraction, more of a marketing ploy for insurance companies to try to act like their products are very good. What I mean by that is like you might have came into contact with, I talk a lot about like a hybrid annuity or annuities with income riders, and you might see some contracts say, oh, we're going to give you a 10% premium bonus, or we're going to give you a guaranteed 7% roll-up. What exactly does that mean? And when you're looking at like a retirement situation, the best ways to leverage annuity contracts for guaranteed income or for retirement income is when you're looking at your specific scenario. So I always say a very important aspect of retirement planning is making sure that your income sources are covered. If we take a quick example of we're sitting down with a client, and let's say they're currently age 60, they want to retire at age 65. And at this age 65, they need exactly $50,000 of income per year to last them for their life or theirs and their spouse's life for the rest of their life. So at age 65, maybe they're going to trigger Social Security income, and that Social Security income is going to be $30,000. So this tells us that there's a specific income gap. Let's say this person's not receiving pension income. They don't have any other guaranteed income sources. What they can do is say, okay, my gap is $20,000. I'm currently age 60. I might have different qualified assets such as 401ks, IRAs, cash accounts. What we could do is leverage an annuity contract, the best one that's going to be a 5-year deferred contract that will produce us this $20,000. So this person could get set up into a deferred income annuity that goes along that same concept of annuitization, where you're losing full control of your monies. You're losing a lot of your control of your monies, and this is where insurance companies love to pitch you on the deferred income annuities. Or you could set it up on a hybrid annuity that says, okay, you get to control your account, allow your account to grow, but then you could still receive a contractual guaranteed income through that lifetime income rider that you're attaching it properly. So it's all about finding which one is the best contract out there for a person age 60 looking to trigger income at age 65. So I guess the question is, how do you know whether or not you're getting set up with a good contract or a bad contract? And unfortunately, there's about 1,200 plus different scenarios that an individual that's in a particular state, that is at a particular age, that has, in this example, a 5-year deferral, that they have all of these different options, over 1,200 plus different options. So it's important to really decipher what is the BS, what is the smoke and mirrors that a company's telling you about a 10% guarantee or a 7% guaranteed roll-up. What exactly does that mean? So this is the easiest example that I could create. If you're utilizing $100,000 worth of examples, you could break down which one is a good contract versus which one is a bad contract, because you could see specifically what is their cash flow number, what exactly is that payout rate, how much income are they receiving in this example. So like, let's say we have an individual that's age 60, that they're going with company A that's giving them a 7% guarantee versus company B that's giving them a 5% guarantee. This individual, and we're just going to use simple interest just for really easy math. And when you're looking at this, you're saying, oh, well, 7% is obviously higher than 5%. This is going to give us, a much higher income stream, with company A as opposed to company B. Now, be mindful, this slide is not talking about the account value, not talking about your actual physical money. This is just talking about that income rider side, that income base. And the way that this is calculated, it's nothing more than a calculation account. It's a phantom account. So this is not your real money. When you're seeing a 5% guarantee or 7% guarantee on the roll-up, all that's saying is that this income base, this income account is going to grow up by a specific dollar amount, and then right when this person wants to trigger income, it's going to be based upon what their age is, and that's going to equal something known as a payout rate percentage, and you're going to multiply that payout rate percentage by whatever that value is at that specific time. So it's going to be the income base multiplied by the payout rate percentage or withdrawal rate percentage, and that's what's going to equal your lifetime income. So in this example, you're going to say, okay, well, if a person's 60 years old, they're looking to trigger income at age 65, their actual income base, when we're comparing the two income bases, this is 107 versus 105, 114 versus 110, et cetera. At age 65, this individual has an income base of 135,000. This person has an income base of 125,000. So when someone's looking at this on the surface, they say, oh, 135 is higher than 125. This must be a much higher income side, right? And no, because the calculation works with what's the income base multiplied by the withdrawal rate percentage. So if we have company A that has a withdrawal rate percentage of 4%, but company B has a withdrawal rate percentage of 5%, the actual values, the annual payout amount is $5,400 versus $6,250. So even though everything on the surface looked like company A was a lot better of a deal, this person, if they place in the $100,000 deposit, they're able to receive a 6.250% cash flow off of their original $100,000 as opposed to a 5.400% cash flow. So It's very, very powerful. That's how you're able to decipher the smoke and mirrors, or saying, okay, what's a good guarantee? What's a bad product? So rather than get held up in, oh, this is a 7% guarantee versus a 5% guarantee, no, what are the actual values? Why are you placing your dollars into this contract, and how can you try to squeeze out the most amount of leverage of the highest income play possible if income is your specific goal? So what we have in office is something known as a retire sharp planning system, where it's able to take an individual situation based upon their age, based upon what their goals are when they want to retire, break down their analysis, and then siphon through the 1,200 plus different options and say, okay, you have company A is going to be in first place, company B will be in second place, company C will be in third place. These are the pros and cons of this one versus, company C. These are the pros and cons, etc. This is what we would recommend. Or you could splice up a portion in company A, portion in company B, portion in company C, and diversify amongst those three, those three specific contracts, so that it's providing you the best annuity for retirement income. You're able to also receive control. Now, if you want to have that risk and say, I don't care about leaving an inheritance, I just want to have the max out income, there's times that the annuitization phase are not as high as the guaranteed lifetime income riders when you attach those income riders onto it. So you're essentially really shooting yourself in the foot when you're going with those annuitization, when you're going with those immediate annuities, as opposed to structuring out an annuity plan properly. And what we try to do is make sure that we're taking your scenario and we're breaking down to very simplistic terms. One of the benefits of our agency, we're an independent agency. So we're not captive. It's not as if you're walking into insurance company XYZ and saying, hey, I'm interested in an annuity. And, surprise, surprise, they're only going to be offering you that one company and their one annuity contract. The odds that that one contract is going to be the best out of the 1,200 different scenarios is slim to none. And the reason why this is so powerful is, let's go off of that same example. And we understand what the cash flow percentages are, and we're going back to that gap. We said before with the example that the gap was $20,000. If we go with company A, which is the common mistake that people make, they would say 20,000 divided by 0.05400 would equate to $370,000 being placed into a contract that will produce them that $20,000, $370,000. If we go with what the correct situation is, we're using the smallest amount of dollars to place into an annuity and only as much as necessary, this person could say, okay, $20,000 is my goal, divided by 0.06250 says $320,000. So in that really quick hypothetical example, that individual is saving $50,000, over $50,000 more into their pocket, rather than waste that into an insurance company so the insurance company could over leverage them. So I really hope that this makes sense. If you're interested in looking at what the best annuities are for retirement income, please feel free to give us a call. We're available 24 hours a day, 7 days a week. Mornings, nights, weekends, holidays. We have our service set up. We work on a national basis. And when calling into our agency, what you could expect is you're going to speak to an assistant. You're going to tell them your situation. You're going to say, hey, I saw a video online on the best annuities for retirement income. Can I please speak with a specialist? That assistant's going to patch you over to a specialist, and that specialist is going to ask you a whole slew of questions to figure out what your situation is, what your goals are. If what you're doing right now for retirement can accomplish those goals, then we're not going to recommend an annuity for you. We're not going to recommend anything for you. We'll just say, hey, listen, go with what you're currently on. Go on the path that you're currently on, because you'll be able to accomplish your goal successfully. Now, if there's a gap, which a majority of the times there are gaps into certain plans, we might give you recommendations on how to suffice those gaps. What are the best possible contracts that you could place a portion of your dollars into, and only as much as necessary to accomplish your retirement income goal, and go through the 1,200 plus different scenarios, because we are an independent agency. We're not going to be biased towards one company over the next. It's whichever is going to be right for your situation. We work for the client. We don't work for the company. We're A+ rated on the Better Business Bureau. I believe it's because of our methodical process. We've always had very good reviews. We've never had any complaints. And what we try to do is educate you guys through literature pieces, through personalized videos, different things to make you more comfortable, so that you're understanding the process. You're becoming educated first and foremost, so that any dollar that you're placing into a plan, you know exactly what the leveraging component is, what exactly it's doing for you. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.